start with issuers. Now, these are companies that are doing business. Their goal is to earn profit from normal business activities, and they want their earnings to show stable earnings, right? They want their income statement to show stable earnings, and they don't want any kind of uncertainty from their business operations to affect the stability of their earnings or cash flows. So what they do is they use derivative instruments to offset any kind of market exposures in that. And I think of the industry, think of the airline getting the derivative oil futures, so that any ups and downs in the oil market don't impact the earnings of the airline, right? Or think about Walmart buying goods from France and Italy and Germany in euros, and the ups and downs of the euro USD should not impact the earnings of Walmart's import export transactions. So they can get into a forward contract for that. So not only do they get into derivatives to do this, they also use very complicated hedge accounting, which means in order to do that, they have to get into a completely customized derivative, which is exactly a copy back to back of the underlying transaction. So for the airline, it will be the oil, exactly the same amount of oil they have to buy for the number of flights that they are having should be equal to the exactly the same amount of barrels of oil that they are getting into the forward contract for. Or Walmart is buying goods from France, Italy and Germany in euros, and if it is getting into the FX forward contract for euros, then the exact amount has to be the same. And usually these type of issuers, they get into customized derivatives so that they can then do the hedge accounting to make sure that the income statement and cash flow statement, the volatility is removed or reduced as much as possible, so that they show their investors and other stakeholders very stable good earnings and cash flows from their businesses. So they do multiple types of hedges for this. One is a cash flow hedge, and think about the Walmart example that I gave you, that because of the euro going up or going down compared to the USD might impact Walmart's cash flows, and that should not impact its income statement and cash flow statement. So what they can do is they can get into a cash flow hedge. And think about the airline example. So a commodities producer anticipating lower prices. So here a producer example would be, let's say, a oil refinery that buys crude oil and then sells refined oil, right? Then they are worried about crude oil prices going up or down. So what they can do is they can lock the crude oil price in a forward contract or a future contract, and then they can just sell their refined oil in advance as well, so that they can make sure that any changes, any fluctuation in the price is not going to impact their profitability. They can buy and sell everything in advance, and they can lock in the prices. Or think about a gold mine that can sell all the expected production of gold in the future already, and so they don't have to worry at what price they will sell all the gold that they are expecting to mine. So then they can just focus on mining and selling the gold as soon as they can lock the prices. So this is called a fair value hedge. Net investment hedge is usually for equity in a foreign operation. So let's say Walmart opens its subsidiary in China, and now the Chinese yuan and the US dollar are going up and down, and that is impacting the amount of investment that Walmart has in China. So what they could do is they could get into an FX swap where the volatility of the foreign exchange will be removed, and their net investment will show much more stable amount. Now, as I told you earlier, to qualify for hedge accounting, it has to be a complete back-to-back copy of the underlying transaction. So the dates, the amounts, and other features must closely match with those of the underlying transaction, and therefore definitely they use customized derivatives which are over the counter, as opposed to exchange traded standardized derivatives which are more liquid, but and investors would definitely prefer those because they are more liquid, but issuers will prefer the customized over the counter derivatives even if they are less liquid. And this brings me to the investor use of derivatives. Investors use derivatives for different reasons. So, number one, they could do it to replicate a cash market strategy. Now, what that means is that instead of buying stocks on cash in the spot market or the cash market, they could just purchase a futures contract and they could get the similar performance, right? So if the market will go up, they will get the profit from their futures contract by investing little or no cash at all. They could even get put options to safeguard their portfolio from significant to protect their portfolio from significant losses. So in case the market crashes, they have the right to sell their stocks, right? So this put option is an example of derivative, a very good strategy to be on the safe side. They could also modify or add exposure, and I gave you the example of the Saudi public investment fund that is holding a lot of shares of their main oil production company, which is Aramco, and they are already holding these shares, and just to generate some additional income, they are selling call options on it and receiving premium. So if they are receiving premium, they are generating extra cash, and even if the people who are buying the call options, they come to buy the shares, then it's not a problem because they already have the Aramco share. So this is what is called a covered call. So investors, they use these type of strategies for using derivatives. Now it depends on the investment fund that we are talking about and what their prospectus entails or describes. So every fund will in detail describe in their prospectus, so that the investor, when choosing an investment fund, can read the prospectus and understand how they use derivative instruments and which derivative instruments will be used and for what purpose, so that before investment you can choose a fund which meets your level of risk appetite. And investors are typically less concerned with hedge accounting than issuers because they are not so much concerned with maintaining stable business income and cash flows. They're more interested in making profits. So they don't go for over-the-counter customized derivatives. Rather, they go for the standardized derivatives which are highly liquid and they can get in and get out whenever they want. Now here is a summary of the entire learning module. We talked about benefits of derivatives, and this is the learning module that this is the learning outcome that covers the benefits of derivatives. We talked about how you can use derivatives to allocate, transfer, and manage risk without trading the underlying asset, right? So you can do all of this without actually trading the underlying assets, and even more, that you can create exposures which are unavailable in cash markets, such as covered calls, right? So you can not only do what is in the cash markets, you can do that and more. And another advantage or benefit of derivatives is that not only do they help you discover the price of the spot market, but they also help you discover the expected risk, or what we call the implied volatility. Next, operational advantages. You can do this without very small cash. The transaction costs are very low. Liquidity is very high, and of course there is the ability to short here as well. And because of all these low cost ability to trade, it brings a lot of efficiency into the market, because as soon as there is a little bit mispricing, the players, they come in and they make it correct, and this is why it makes the market very efficient. Now moving on to the second learning outcome in this learning module is the risks. And we talked about, because of the leverage, why there is a greater potential for speculative use, because you can use very little cash and create very large positions, and that leads to a much greater potential of speculative use. And when there are private transactions and very, very complex transactions, then what you have is a lack of transparency, which is not very well understood by the stakeholders, and this could create a problem later on, right? Then we talked about basis risk, which is the difference between the expected value of the derivative instrument versus the underlying hedged transaction. So we talked about the airline gaining from the futures oil contract, whereas losing when the oil price goes up and they're having to buy oil at a higher price. So the gain and loss could be exactly the same, or they could be a little bit different. And if there is a little bit difference between the two, that is what is known as basis risk. Then we talked about liquidity risk, that you have to have mark to market margin, and sometimes your underlying transaction is going to be next season or next year, and but your mark to market is now today, and if, in case you run out of cash, then what you face is something called liquidity risk, that the derivative transaction will be closed and it will not remain open unless you can post the margin. Then we also talked about counterparty risk, especially with a call option. So the receiver of the premium, the party that is the short party of the call option, or the seller of the call option, or the writer of the call option, they are receiving the premium, so their risk is limited. But if you are the one paying the premium, right, and you are hoping to exercise your right if this underlying asset goes up, and it could go up to anything, right? So your risk is basically infinite to this counterparty. So this counterparty risk can be very, very dangerous, especially when we combine all these risks and with the greater potential for speculative use. So let's say the transactions are in billions and even trillions, which means the counterparty risk is in trillions, and then all of it comes together at a system level, and this is what we call destabilization and systemic risk, that one after the other financial institutions could topple because they then owe each other a lot of money. And because of the excessive risk taking and use of leverage, what happens is that it could lead to an overall market wide stress, as it did in the 2008 financial crisis. So this is definitely one of the main risks of derivatives. And the last learning outcome over here for this learning module is the comparison between the use of derivatives among issuers and investors. So issuers, definitely they are using derivatives to hedge their market-based underlying exposures that impact their assets, liabilities, or earnings. So they just want to have normal business earnings, they want stable earnings, and they don't want the volatility of the market and asset prices and exchange rates to impact their business income. So they use derivatives to not only hedge these risks, but they also use hedge accounting to make sure that the impact on their income statement and balance sheet and cash flow statement is minimized. And in order to do that, they need to use customized derivatives, and this does reduce the income statement and cash flow volatility. Investors, on the other hand, they use derivatives to replicate cash market strategy and protect a fund value against adverse movements, such as using a put option, or they can modify or add exposures using derivatives such as a covered call, and these strategies are unavailable in the cash markets, and they will use more standardized products which are highly liquid, right, compared to your issuers which will use customized products, because that is what they need to do if they want to use the hedge accounting. So that brings us to the end of this learning module, and hope to see you in the next video for the next learning module.